Perfect. Thanks, Steve. Sounds like you guys can hear me. Last panel before lunch, so hopefully we can keep you guys awake. A good representation here, I think, from both investors and sponsor side. So to my left here is, or right, I guess, what you're looking for, Peter Miller from Neuberger, Jennifer Montero from the CFO of Citizens, Zhak Cohen from Gallatin Point, and then we got Chin Lu from Amundi. So I think the next kind of hour, we wanted to kind of talk about the cat bond market and really finding a balance between sponsors and investors. Also, I think, again, hopefully good representation here from both sides. To kind of kick us off, want to talk a little bit about first the rear view mirror, looking at 2024 and talk a little bit about the experiences, maybe first from an investor perspective and then secondly, maybe from a sponsor perspective. I think the first question, obviously, 24, very solid, strong returns, or I think pretty substantial growth. I know, Chin, if you want to maybe kick us off with some of your investor views, experiences, and comments.
Yeah, I guess obviously we had fantastic 2 years, 23 and 24, the best ever in the Swiss Re Cat Bond Index history. That delivers, I think, messages and testimonies to both sides, right, to investors and to sponsors. To investors, I think that's a strong message. This is a for-profit sector. There is long-term profit and long-term stable return in the asset class. And sometimes we're saying this is almost like a self-healing asset class because it's must-have nature in the economic system, right? When we face losses, we see that many times. When you had a car accident, your premium, jumped to the roof. When the sector faced a few years of challenging performance, we see that self-correction. Also on the other side, right, when premium jump up high, similar to last cycle from 2005 on all the way to 2016, 17, premium is not gonna, come back to the tight level immediately, right? So investors will have a few good years run. That's what we're seeing in 2023, 24, even extending into 2025. On the other side, right, I think the message to the sponsors, the cedents, is that, obviously, capital is here for the long term to support their business. But as we mentioned, right, we need to see profitability, in the transactions. And also, always say, either reinsurance capital or ILS capital is a solution for volatility, but we are not a solution for profitability, right? The profitability has to be achieved through better rates, better premium from the inward business, right? You can't just simply say, let me just get rid of those non-profitable or money-losing business to the investors. That's not going to last long, right? So I think we have to remember really the purpose and the function of the capital is really to help you in those really truly tail events, right? Not really help you on those random volatility or profitability. So.
And then maybe one follow-up question, and then Peter, interested to hear kind of your perspective. So, but Chin, maybe just from obviously looking back, or I think 2024, very profitable year. We have seen some kind of pricing volatility throughout that time, or obviously also a number of events. Maybe just kind of adding a few more words on.
Yeah. So as we mentioned, right, I think generally speaking, we're going through a large cycle, from similar 2005, 2006, 2016, and now, we're seeing price widen up significantly end of 22, and we're seeing a slow spread tightening process. Obviously, during this process, similar to the broader capital market, we will see mini cycles sort of in between, right? April, May, June of 2024 was a good example where capacity being used up due to very strong issuance, and all of a sudden, we as a market participant had observed some, we'll call it small hiccups of spread widening for a few months. Three things, I think we learned from it, right? First, really, it's very critical to have that education with your investors, right? Any bond, right? This is a bond. So it comes not, only with features from catastrophe, but also from spread environment, spread widening. So you will see that type of short-term volatility in the bond portfolio. However, right, compared with their experience, for example, in high yield in the banking sector, I would say that type of 100 basis point plus or minus of price volatility is not that extreme, right? But I think the education ahead of time to let them know they could potentially face this type of volatility is critical. Second, right, we thought about that as an investor, are we able to, or can we really take advantage of the market volatility? Obviously, if you were a large institutional investor with sort of very flexible capacity, you will be able to jump in right away. However, as a dedicated cap fund manager, it is very challenging, right? Because you don't really know when that would happen, and there's cash drag in your portfolio, so you can't just say, let me set aside 1, 2, 3, 4% of capital in response or be prepared for that scenario. So I think, again, that comes back to the earlier point is we just have to educate our investors about this potential volatility, using this really as an opportunity to increase your allocation if you are still in favor or feel bullish about this asset class versus having any knee-jerk reaction, just redeem, at the sight of those short-term volatility.
Okay, thank you. Peter, do you want to, maybe from the Neuberger side?
I mean, yeah, I would echo Chin's comments on the, obviously 2024 is a great year. Record issuance, almost record profits. I guess 2023 was a little bit better, but just addressing the bit about the sort of mini cycle we saw last year, I think it's really critical that we, as a market, get a little bit better about matching both the pipeline and the capital. Because obviously what happened last year is there's this huge maturity wall in the beginning of January, then there's no issuance for a month. Whether that was held back or on purpose, I don't really know, but the desk will tell you. And then all of a sudden the issuance came and everybody started, gorging themselves on additional notional. So, and then we got to June and there was no money to support extra issuance. So it's not good from an investor's perspective, although they might like widening. I think long term it does damage because I think it's hard for sponsors to come to market if they can't predict where the spreads are going to be. And similarly, if spread widens, you start to have mark-to-market movements, and no investor wants to open their statement up and see, oh, I'm -2 for the month. What happened? Oh, nothing. We're just sort of in a spread widening phase. Yeah. It's explainable, but it's a conversation you'd rather not have, I think. So I think if we worked a little bit better together about timing, communicating the pipeline, and then working on bringing capital to market at the appropriate time, I think we can get over these sort of mini cycles that we've had. I think the last, certainly in 2022 and 2024, both had them. So it's a bug, not a feature. Yeah,
no, absolutely. And maybe kind of that's a good kind of maybe jumping off point from a more sponsor type perspective, and maybe Jennifer, you can kind of give a little bit the perspective. I mean, obviously, and Peter, to your point, it obviously takes time to put these deals together, and I think the challenge we're obviously facing is sometimes, or there are strategic purchases, sometimes there are obviously purchases also driven to a degree from about the pricing environment, and obviously sometimes it takes time to put these deals together, and matching that is obviously sometimes more challenging, but obviously ongoing communication will hopefully help. But I think, Jennifer, from your perspective, the citizens are heavy user of the cat bond product. Talking a little bit about, again, looking first into the rearview mirror, your experiences, I think also what Peter mentioned, or the kind of sometimes price volatility, and how do you deal with that from a capacity and price perspective?
Sure. So we did go a little bit later last year compared to the rest of the issuers that were out there, and we were trying to do a $2 billion deal, and we did get 1.1, which was very successful, but the capital did run out. The opportunistic investors left. All the news said, the season from hell, and was going to be the worst storm ever. So it was successful because we were able to get a lot, and we do need both markets, both the traditional and the capital market, to get the capacity that we need. But we did come up short, about $1 billion. So it was that was disappointing. But we're going to go back out this year and try to fill that gap. But it was It was the same time we usually go, so it was just the rest of. There were, I guess, 3 companies that all did $1 billion, and we were last of the 3. So.
Yeah, no, and I think to your point, though, I think, I mean, it's not uncommon. I think we face often these discussions with sponsors, or especially sponsors who can bring very large limits to the marketplace. I think that predictability, and it's, I don't know what you feel is, Jennifer, but it's sometimes even less about price. So I think it's more about capacity, availability. And again, because you have a 3 to 6 months process to put these things in motion and design your reinsurance program, obviously, kind of having kind of certainty around that is obviously important. But
and the pricing is important too.
Yeah, no, absolutely, no, absolutely. But I think it's, and again, I mean, I think maybe just kind of before we kind of go to another topic, I think maybe just on this capacity, predictability, and I think Chin, you mentioned a little bit. It depends obviously on what type of fund manager you are. But I mean, do you want to make just maybe some comments on kind of pipeline planning and how what you can do there?
Sure. I guess, to Peter's point, right? I mean, or unfortunately, right, with all these sponsors, there is a competition, right? To your point, selfishly speaking, right? Sponsor A, they want the best execution. Who cares about B and C, right? When you have 3 $1 billion deals coming to the market, there is a competition for capacity. And to your point, there is that 3 to 6 months of lag in time, right? So you can't just announce your deal 3 months or 6 months ahead of time and not doing it, right? So you're facing a lot of reputational damage. So I think, unfortunately, right, that pipeline management is extremely critical. Because also as a manager, right, we could face a situation where, Jennifer may tell us, say, we're gonna do a $2 billion deal, right? You prepare your capital, and all of a sudden, something happened, they only do $500 million. So where do I put that money to work, right? So I can only put money to work at the deals that's live in the market. So I think that will always be the challenge in the market. I think better communication would really facilitate a better long-term execution, right? You may not achieve the absolute best execution for the sponsor for that year, but over long term, that reduce some of the volatility. But also, I think at the other end, right, like for example, our capital structure, as people know, we have our dedicated funds, and we also have multi-sector funds that have that flexibility. We can, respond to those market conditions by allocating 1 to 3% more of a much bigger pool. We can't absorb everything, but I think, we're well positioned, if that happens, to, take advantage of it, right? To be fair, because of the uniqueness and then the very special knowledge of our asset class, right? It's almost impossible you go to a non-cat bond investor, say, now you're seeing 100 basis point wider spread coming in, right? So this would only happen within the community where someone has that long-term knowledge, but a slightly different capacity source to really help absorb this type of volatility.
Yeah.
And we actually went out for more than we typically do because we had 3 separate accounts that we had cat bonds on, and we were merging our accounts. So the year before, in 2023, we had to pretty much get rid of everything before we went into 24. So we were starting with nothing where typically we have outstanding cat bonds. So our capacity need was much larger than typical. So that was on us.
Yeah. And then Peter, maybe just kind of on these managing also your investors and inflows, if you want to comment a little bit about that as well.
Yeah, I mean, I think it's, I think everyone in this room probably understands it's, capital raising is a long, hard process. If you call somebody the next day, they're not going to send you a check. It's a long education process, and managing that flow to come in at the right time, not in the middle of the summer when there's not going to be bonds to invest in, and you're going to try and build something to the secondary. Maybe that will work, maybe that won't. Yeah. It's all about timing, and it takes a really long time to get investors on board and become clients. And I think they will understand if you tell them, wait a couple months.
Okay.
And if you're raising for something that's happening right now, chances are by the time you get the money, it's going to be completely different. So it's an ever-changing business.
No, absolutely. Okay. And then, Zhak, maybe from your perspective, obviously, kind of somewhat new to the cat bond market as a sponsor. I don't know, maybe for the benefit of the audience, I don't know if you want to kind of give a little bit more background around Gallatin Point and like kind of how you first kind of got into the cat bond market and why, but.
Yeah, sure. So why are we here? Or why am I here specifically? That's a question I ask myself often. So I think for Gallatin Point, we're a financial services investment firm with a PE-style mandate. And so our return threshold's traditionally 20% plus. We invest across financial services, so not insurance exclusively, but insurance by way of affinity, opportunity, and Rolodex ends up taking up a lot of our overall portfolio, approximately 70%. And within that, we do life, health, and PNC. Unlike most insurance companies, unlike most PE companies, we don't shy away from balance sheet risk. And a lot of our best investments have ended up marrying equity together with balance sheet, whether that's capitalizing a new balance sheet for a reciprocal and taking a portion of the AIF, or more traditionally working with carriers and being able to take on equity slices for taking that risk. In our latest fund, we were very cognizant that the conversion to reciprocals was something that the market wanted and needed, particularly in spaces such as Florida. And so we wanted to ensure that our overall concentration limit to natural catastrophe, which is not our inherent risk that we take, and not an inherent part of our mandate from our LPs, would be limited. And so we were very cognizant on the way in as to what the overall composition would be. What we didn't fully appreciate, which is a good problem to have, was that the investments would do quite well. And because they did well and appreciated quickly in value, the natural catastrophe risk ended up being a larger part of our overall portfolio than we would overall want it to be. And so we had a decision to make. What do we do? Do we sell some of the underlying positions? For example, we have an equity position in Tower Hill's Attorney in Fact, and we have $200 million in notes. Do you sell the notes? Do you sell the AIF? How do you best work with the assets that you have in the market that exists? And the truth is we like the investments, and we continue to enjoy good returns, good IRRs on the investments. And so the idea we had was, instead of selling the underlying equity investment, why not find somebody else whose mandate marries well with ours, where we are focused on execution, regulatory, timing, management risk, but not necessarily exclusively on cat risk. Why not find somebody who's the yin to our yang, who's looking more to take the natural catastrophe risk, but not so much the timing, regulatory, management, operational risk, and see whether our capital sources and whether our respective mandates could together create a sum that's greater than the independent parts. And that's what we found. We came to market with Marlin Ltd, thanks to the team at Howden, and we were able to issue a $150 million cat bond and a $25 million ILW to protect the underlying position for the Tower Hill portfolio. We have a lot more in our portfolio that we could do, so we consider this a dipping the waters exercise. But as we met people in this room and met the ecosystem, we become more and more bullish on this being something that could be thematic, not just for Gallatin, but for others in the private equity industry, and perhaps a good source for increased issuances into the ILS market.
And then, Zhak, on that point, obviously, as a first-time kind of issuer into the space, I mean, if you want to talk a little bit about experiences or what was the process like, and also, is there things that the market, like how did you find that receptivity from the marketplace, from investors?
Yeah, so without wanting this to sound too much like a Howden plug, I think we ourselves are not well equipped to do the underlying analytics in the way that a lot of other people in this room are to perfectly model, what is the basis risk of an index issuance relative to our overall equity portfolio. But what we've discovered that there are a lot of smart people in this industry, a lot of them in this room here today, who could help us do that work and be able to wrap our arms around what are our underlying exposures, how do we bring the issuance to market. And there was definitely an educational process for us, but the overall execution was relatively seamless. We did a roadshow, we met a number of the investors, we explained why we were there and what we were looking to accomplish, and I think the reception was overall very positive, and again, one that would make us inclined to do this again at scale. We have several $1 billion of equity that we can hedge through these type of instruments, and we're a small fish in the overall equity pond. And so I think that our overall experience was positive. It was, again, reliant on smart service providers and on getting comfortable with how this overall market could play with our source of capital.
Yeah. And maybe kind of switching to the investor side, or I think, Chin and Peter, obviously, they're very different kind of sponsors. Or Gallatin Point, which is more financial investor, Jennifer coming more from the insurance company's background. There's obviously the risk metrics and other things you look at. I don't know if maybe both of you could share some of your perspectives on, are you looking at, kind of how you're looking at the sponsor and the motivation and things like that. But Peter, I don't know if you want to...
We definitely need more sponsors in the market like Zhak and Gallatin. Opening up different types of sponsors is, I think, going to be a key to opening up the next $50 billion of growth in the capital market. So whether it's private equity or real estate, I think there's a long way to go. We're probably on the whole climate regulation piece that we've been talking about for a long time. We're probably a few years away now. Just got pushed back. But I think it's tremendous to have new sponsors and obviously continuing sponsors as well. We need to continue to grow the market, and new sponsors is clearly the best way to do that.
Yeah, I would agree. Right? As all we see here, we want the market to continue to grow. So, having new sponsors come into the space. Right? In the past we had corporate sponsors. Now private equity coming to the market. I think that's extremely helpful. I guess when it comes to risk analysis, right? I think we carry the same mindset, right? As sort of a traditional sponsor, looking at the mindset, the alignment of interest, their track record, their underwriting practice, claim management practice, right? In the end, right, the underlying business is still an insurance business, right? So I guess that's similar risk analysis approach. Obviously, you would argue, say, maybe the new sponsors potentially could be a little more opportunistic compared with, a traditional sponsor like Jennifer, right? We know they're going to be in the market day in, day out. Yeah. So I think, that takes some effort, right, to understand the motivation, to understand, right, the capital or their demand is also here for the long term. So glad to see sort of the repeated issuance, right? And obviously, when you have more sponsors coming to the space, making this even more healthier, ecosystem, I think, investor would get more comfortable around it.
Yeah, I think the repetition is pretty key because we've had a lot of one-time interesting deals that have not come back. We need them to come again.
Yeah. And maybe kind of drilling into a little bit deeper, and Jennifer, from your perspective, obviously kind of going into the market, there's indemnity deals, index deals, you obviously have also done too. Maybe just quickly diving into that in a few minutes on how do you look at that, obviously basis risk versus...
Sure, so we've always done, up until 2023, always done indemnity deals since 2012. And we did do one index deal, and it was Lightning Re. It's a $500 million bond we did in 2023. And we did that because we were merging our three accounts. Yeah. And to do that, we couldn't have any financial debt or any other obligation in one account. So we had to wait till everything either matured or expired, or we defeased some bonds and called some cat bonds. And then we did the Lightning Re so that it could sit over all three accounts since it's an index bond. That was done specifically because we were merging the accounts. It's not something that we would do in the future, probably because of the basis risk. Indemnity seems to fit better with what we do and what our mission is, to be the residual market for Florida and to try to match the actual loss with what we are getting, rather than an index with the industry and having the basis loss that's hard to explain to a board that's watching you.
Closely.
Very closely, yes.
No.
So we prefer the indemnity. So that's probably the way we will continue to go unless something changes.
Yeah, and to your point, there's obviously different objectives and reasons why, and again, similar to Zhak, there's obviously...
In Lightning Re was extremely popular. Yeah. We had so many people call afterwards and say, can you do more? Will you do more? Will you do more? Yeah. And it wasn't part of our strategy. So.
Yeah. And Peter, again, on that point, I think, obviously, Neuberger also very big on the index side from a fund perspective. Maybe just a few words on kind of when you talk to your investors, how they look at both. There's obviously somewhat different pricing volatility and cycles we have seen.
Yeah, it's no secret that index is the NB flavor, at least when we're building portfolios. Yeah, when we're talking about index, it's something we're very used to. It's obviously the comfort around the risk is number one. There's obviously a lot of sort of ancillary benefits, no adverse selection, faster settlement. It's that's what's drawn us to the index side, but we are participating in indemnity deals as well, just to a little bit of a lesser extent, and where we can get comfortable with that risk analysis.
Yeah. Jen, any comments on kind of the product?
Yeah, obviously, I think as an investment manager, we are in favor of index transactions because of the cleanness, right? But right now they are probably 20-ish% of the overall Swiss Re index, right? So we can't really do much. One small concern we have on our end, right, is really the potential very high correlation between all those index aggregate, right? Regulators sometimes they don't go that smart. They ask you not have certain exposure to one sort of cedant or one sale. But for me, what's the difference between 2% EL index aggregate transaction from 2, 3, 4 different sponsors, right? So just on our end, probably we need to manage that potential tail and educate our investors, right? You may not have as much of a diversification as you thought, by just simply looking at how many index aggregate deals you have there.
Yeah. Okay, I think that's helpful. And then maybe kind of switching from the rear view kind of to today's environment, would be good. And maybe starting a little bit from the investor side. There's strong year 2024. Obviously not so great start into the 2025 year. Obviously also questions from investors, I assume, about what kind of the outlook for the next few months kind of is. I don't know, Peter, if you want to talk a little bit about investor sentiment or like what concerns are you hearing out there?
Yeah, sure. If you asked me a month ago what I thought 2025 was going to hold, it would have given you a very different answer. And there's a lot of uncertainty, surrounding the wildfires, obviously. But then there's the sort of macro environment uncertainty as well, regarding interest rates. And then the knock-on effect of the fires and potentially the macro environment is what is inflation going to do? So the risk environment is somewhat uncertain as well. I think the key for 2025 is going to be managing expectations because I think sitting here right now, we know with pretty much mathematical certainty it's going to be really hard to repeat 2024 and 2023. So managing those expectations with clients is going to be super crucial. I think the concern out there right now is that spreads are compressing. They're probably compressing a little too quickly for most of our liking. And how do we fix that? I don't have the answer, but it's something hopefully we can slow or even reverse. So.
Yeah. Jen, do you want to?
Yeah, I guess for 25, generally speaking, I think to Peter's point, managing investors' expectation is critical, right? I think we have been there very loud telling our investor, right? Do not expect the same level of return for 22 or 23 or 24, right? Mathematically, it's very, very unlikely. So I think it's very critical to send that message out. But also working with the investor, I guess, we are probably having a little two tailwinds for this asset class, right? Number one, because of the floating nature, I think, glad to see the Fed is pausing their pace. So we're still enjoying, a very high 4.25% of risk-free rate. So that helps the return potential, the yield. But also, I think from a allocator point of view, as we know, the competing asset class, right, broadly speaking, like, high yield or bank loan to a certain extent, securitized credit, or even investment grade corporate, those asset classes are at or close to their historical tight. High yield spread is sub 300 basis points, IG is 70-ish basis points, right? So for our client, for our investors, when they are facing the asset allocation challenges, this asset class actually looks, very, very bright. And because of that, right, I think investors are also reducing their return expectation for this asset class, because if they can only get 7.3% yield from their high yield allocation, a close to 10% yield for cat bond is actually, very, very attractive to them, right? So they're not just comparing the return potential with our own history. They're comparing really the return potential with the opportunity set ahead of them. Having said that, right, I mean, probably a negative for this asset class is that we probably will see a little higher correlation between cat bond and the broader financial market. Not necessarily on the loss side, right? Because I know our losses are still independent of the financial market behavior. But on the return potential side, I think going forward, we will see some correlation where when the capital market return is low, probably we will see slightly lower return. And on the other side, right, imagine there's a sell-off in high yield. All of a sudden, high yield spread become 900 basis points, high yield yield become 14%. Probably we will be facing some reallocation challenges, or we as a sector will be facing some redemption, not because we did poorly, right? Just because investor would have much better return potential in other asset classes. That would potentially, having some spread widening impact for our asset class and having some capacity impact to our asset class, right? So I think probably we should also be prepared for that scenario, not just saying now we get the benefits of spread compressing because of a very tight, sort of financial market condition. But when the other market changes, we shouldn't complain and say, "Oh, we didn't have losses. Why now all of a sudden, we have to pay more, more spreads," right?
Yeah, no, absolutely. And then again, I mean, obviously, despite spread compression, I think historically, from a historical comparison, I think we certainly still sit at a very healthy level. Maybe a similar question, Zhak, to you. Also, you're obviously kind of new to the space to some degree, but obviously discuss with a lot of investors, and I'm sure the ILS topic is coming up increasingly. I don't know if you wouldn't mind sharing a little bit your perspective, or like what are you hearing from investors who are not necessarily directly invested in the space? Any comments you would like to share there?
Yeah, sure. So I think we wear a couple of hats into the conversation. One is as an owner of a bunch of carriers that use ILS in their overall structure. And so it's not completely new to us to look at the ILS solution as both a diversifier as well as a source of capital, a structural source of capital source for the various companies in which we invest. And from that perspective, I think the companies and the management seem bullish on their ability to come out to market and also achieve good execution on their overall issuances. And so I think we thematically see a lot of positive growth there. Wearing the hat that I usually wear, 99.9% of the time as an investor myself, this asset class, I think, has a lot of virtues to it. I think the correlation relative to the other parts of the market is true and fair and increasingly important as people become more sophisticated in their own portfolio analysis and the ability to understand their own portfolios and how their assets and portfolio companies correlate to one another. which is happening on an increasing level. And I think when they do that, this will become more appealing. Having said that, I would say that from my seat, it would be difficult to put private equity money, given the return hurdles we need, into traditional ILS. I think there are ways to structure it together and to figure out how we could deploy into these opportunities. But I think the notion that one would deploy opportunistically and into a single year because it's a hard market is not one that resonates as much to us personally. I think for us, it was discussed earlier, if it's a strategic, longer term allocation through a cycle, that I think is interesting because the market over that time period has enough time to correct itself from a pricing perspective. But the idea that we would come in and out opportunistically, again, has less appeal. That's in part because we're a private equity company and not a hedge fund, but also in part because I think from a statistical perspective, it's probably better to be a strategic allocation through a cycle and accept the overall return through that cycle, good and bad, on an uncorrelated level. And there, I think this asset class shines. I would also say, last thing, I think Steve and team have done a remarkable job of helping create an asset class where one may not have otherwise been created, right? I think the educational process, the ability to have true transparency on the market enables outside investors. And for us, as somebody who is learning about the space, the resource has been invaluable to see that you're able to have year over year analysis of what you can expect in terms of an overall risk return profile by playing in the space is first order critical. And so I really do commend you for what you've built, because I think it's core to making the asset class work, especially for new entrants such as us.
Yep. So I think on kind of talking about questions and education from investors, I think we probably would be remiss not to talk about the wildfires briefly, to touch upon that. And again, I think maybe Peter and Chin, from your perspective, I'm sure a lot of work went into that over the last few weeks, which I think we are sometimes on the receiving end. But yeah, I don't know, Peter, maybe if you want to kind of start just initial investor reactions or just thoughts from your perspective.
Yeah, sure. I mean, obviously it's devastating and tragic what has happened, but I think it actually reinforces investors' belief in the cat bonds in particular, where they sit in this capital stack. The fact that it is limited in impact, I think gives investors quite a bit of comfort on where they're sort of sitting. Obviously, there will be some losses, but they will be, pretty limited, even if you're in all those names. So, and then I think the big outstanding question that investors are asking is that what's the trade-off on demand? Is there going to be some sort of multiple on the record issuance that we're sort of expecting for this year, or is that going to be business as usual? I guess listening to the earlier panel, they think it's going to be business as usual, but we probably don't all agree on that.
Yeah, I would say, as we mentioned, I mean, this is definitely a very, very sad event, but also serve as a wake-up call to investors to make sure a prudent underwriting practice, hold firm on retention and coverage, right? I mean, probably the benefit of cat bond investors, most of the bonds are very well defined, and most of the bonds don't cover fire. So, but again, if you are an investor in a more diversified strategy in the traditional reinsurance market, right, collateral re, quote share, others, you may be feeling slightly different, right? There will be losses or exposure in the other market. In terms of its impact, right? I mean, I would say, I personally feel probably we will see some price impact, really driven by the fact, this is just in January, right? I mean, if some major national carriers tower being hard, even for layer 1, 2, 3, they will probably likely need some backup cover, right? So we're talking about potentially billions of need for backup cover that would potentially suck up some of the capacity from the market. So we'll see, right? But I feel there will be some impact on the pricing for mid-year renewal. And also, if this is really a, call it 30 to 50% loss ratio event, they're going to use up a lot of the cat budget for a lot of the large reinsurers. So they probably have to be a little more careful when it comes to mid-year renewal about how much capacity they are willing or able to put in the market, right? So on one side, you have more careful writers in terms of capacity deployment. On the other side, besides the regular renewal capacity, you have billions or more of backup cover need. So that probably will put some pressure on price. In terms of investors' appetite on wildfire, I would say so far, my conversation with our investors, nobody had any appetite to say, I want you to write wildfire, or I want you to take advantage of this market condition, right? Very sad to report that. I guess investors, I think they're still in the process of say, do we really understand the peril, right? Are we really fairly pricing the peril? Sometimes we joke, say there's no bad risk, but bad pricing. So I think, unfortunately, there will be a significant gap between how much investors are willing to take the peril on their portfolio, for a certain price, versus how much a sponsor is willing or able to pay for the price. Again, we know some major renewal going to happen in March or April, so we'll see. But I mean, at this stage, right, at least direct feedback from our investors, nobody give us the mandate, say, go ahead and write some opportunistic wildfire cover.
Peter, maybe just before we move on to the next question, just on wildfire again, just maybe kind of sentiment on some of the discussions.
I think the feedback is the same. We're very much risk-first shop. Having comfort around the modeling is crucial. And while we're improving, I think we probably still have a way to go. And this is going to, as with every event, we're going to learn something more, and the models are going to update. And luckily in the cat bond world, we're always updating to the latest and greatest, which isn't necessarily the case in other parts of the market. So one day maybe, but yeah, not immediately.
Yeah. Okay. No. So maybe shifting gears a little bit also, I think, obviously the mid-year renewals are coming up, and Florida is obviously going to be a very big part of that. I think, Jennifer, maybe a question to you, or Helene, Milton happened, so it was I think the wildfires obviously overshadow some of the recent weeks. So I think certainly it was a somewhat active season. I think we have seen some of these events maybe end up, luckily, at the lower end of, I think, what people initially thought. But yeah, maybe just kind of giving a little bit feedback from somebody who is obviously intrinsically involved in the Florida market on your outlook.
Sure. Yeah. So Helene in Florida hit in a very rural place that does not have a lot of insured values there. It was hit the third time in 12 months. We had Idalia in 23 hit there, so did Debbie in 2024, and then you had Helene go through the exact same county. So there was still a lot of unrepaired damage from Idalia when it went through. Like I said, there's a lot of uninsured, a lot of underinsured policies there, so there was not a lot of insurance losses. The majority of our claims, though, however, did not come from the place where it hit landfall. It came from the west coast of Florida, way to hundreds of miles below that, where the surge hit. And that was the top number of our claims were down in the Tampa Bay area. Unfortunately, the majority of Helene was all flood, very little wind at all. So again, it was a horrible event, but it's not covered by property, it's covered by flood. And the majority of that was the NFIP, the National Flood Insurance Program. And the problem with that program is they max out at $250,000 for coverage A, and their coverage C is less than 50%. So that brought on some difficulties with people. They also require that you get a declination from your insurance company before they will pay. So you have to go through your insurance company, your primary, have them adjust the claim, come back with the denial, knowing that they have full coverage, but it's not coverage for flood, then go back to the NFIP and get their $250,000 check to rebuild their $800,000, $900,000 building, so our house. So that's caused a lot of turmoil. And then, of course, Milton comes straight in from the west into that same area. Milton was a much bigger wind event. However, the wind in the inland wasn't nearly as fast. The wind speeds weren't nearly as high as we originally thought. In fact, a lot of Milton is also coming in either below the deductible or it's not a covered event because it's flood. And the wind that we do have is it's not nearly as severe as we thought. For Milton, it occurred after 9:30, so we have been booking the modeled numbers, and we're finding big variances between the models. Right now, we've got, to put it in perspective, for Debbie, we've got about $68 million of total incurred loss in LAE. For Helene, it's about $429.7 million, something like that. And then for Milton, we're using the model numbers, which are way high, and they're like $3.89 billion. So we're in the midst of doing year-end reserves. We expect all three storms to come down, but we expect Milton to come down by over $1 billion in loss from what the models are showing, based on the fact that the damage is not the wind damage. I want to keep saying wind because there's a lot of damage, it's just not wind, that the wind damage is actually lower than we anticipated. So we probably will have no recoveries from private reinsurance for any of the storms for 2024.
Okay. So as you look forward to kind of your renewals, I mean, any
well,
views you want to share here?
Well, we again have been depopulating, so our exposure is lower. So you would think we don't need as much, but in the traditional market, we can't get multi-year like we can with this wonderful market, which we really like the multi-year lock stuff in, because we do have to. Otherwise, we're trying to get almost $5 billion of coverage between the two markets every year, and that's not always plausible. But we're hoping that 2025 will be a better year. We're trying to come out a little bit early in the cat bond side. We're going to need about 4.5-ish is what we estimated. We've got to redo some of our forecasts based on depopulation, things like that. But we're hoping to. We do have 1.1 billion from last year in Everglades Re. We still have the 500 in Lightning Re for this year. So we've got $1.6 billion, and we need about 4.5. So we'll be coming, to both markets, and we're hoping that we can get out there and get the capacity that we need between the two. And this is an important market for us. I mean, there are a lot of good things. It offers multi-year, it's aggregate coverage, it's diversification there. It helps with our pricing when we have the two markets, and it gives us the capacity we need. So it's integral to our whole program. So we almost every year. I think there are only 2 years since I've been doing this since 2014. We've been in the cat bond market since 2012. And I think there are only 2 years that we did not issue bonds, 2018, I think, and one other year. And that's because we shrunk significantly and we had multi-year coverage in both markets back then because the prices were going down. So the reinsurers were happy to lock it in at the higher price. But so we'll see. It is an important market. So we'll be in both markets like we always are.
Yeah. And then just one follow-up question, and maybe that's also of interest to the audience. So in respect of the litigation environment and the AOBs, obviously a lot of changes occurred, which so certainly can be seen as fairly material improvement. I mean, I think, do you feel you get from reinsurers and investors the right credit? Any other thoughts?
Definitely, we are seeing, if we look at our data, we look at the public data, there's definitely a trend that litigation is going down. Our litigation rate from 22 to 23 cut by 50%, and 24 is staying about level with that. The thing about the new storms that we just had, because of the reforms in Florida, there's no AOB, there's no one-way attorney fees, and they only have 1 year to file their claim. We're not seeing anything strange with the storms. I've reached out to our chief actuary, Brian Donovan, about that before I came, because he's in the middle of that year-end loss analysis, and he's not seeing any strange behavior, like a whole bunch of claims coming in, knowing that it's only 1 year. Now, what the 1-year anniversary of that date looks like, who knows? Usually we get a whole bunch of stuff that comes in, as long as they're not busy with something else, another storm's out there. Then, but it's like whack-a-mole, and we had this with sinkhole, we had it with non-weather water, and so you just have to watch the loss trends early and keep an eye on it. We saw this, and this is why we actually got our Irma number correct for the most part, on the part that was reinsured anyways, the coastal account, because we saw all the trends that were happening in Miami-Dade. We insured more than 50% of that area, and we saw the litigation, and we saw the fraud, and so we accounted for that, and I think that's the big thing. I think right now we're trying to just play defense with the legislature, don't take it away. That's the fears, they're gonna take it away. Trial lawyers will get in there and change it. But right now it's working, and it's working not just for us, for all of Florida.
Yeah. Zach, any other, we more getting familiar with Florida from your side, any comments in respect of the?
Largely consistent. We have 4 companies that write in Florida, and for the most part, we are seeing improved outcomes due to the regulations. I think last year, consistent with most people in this room would believe, our losses came right up to the retention and then kind of stopped. But that's, from our perspective, that's just fine. I think it's very good for the reinsurance market and for this market to make money regularly, so it could be an important structural partner over time. And there will be years where the losses will come to the other side. But I think overall this year, completely consistent in terms of both the outcomes that we're seeing and where our losses came up to in terms of our overall programs.
Yeah, and obviously good to see that despite having events like Milton and Helene, still strong 2024 performance across many strategies. I think, and cautious of time, but maybe Peter and Chin, obviously Florida is an important component of the entire ILS market. Maybe from your perspective, like outlook, how you're thinking about Florida is obviously a number of deals as well, which are already on the way. But yeah, any comments there from your perspective?
Yeah, I think obviously Jennifer has a much better insight into the environment on the ground than we do. But the reforms seem to have done the trick, and the post-loss experience seems to be a lot better than it was, certainly than a few years ago, better than Ian. So I think the main thing is hoping that it sticks. And with I guess the governor's term is up at the end of the year or end of next year. So there's always that sort of political risk hanging in the background, but we're very encouraged by what's happened in Florida. So we're leaning in.
Yeah, I think we are slowly sort of giving some credit to this reform, right? I remember, beginning of 23, we're saying, despite all the good news in paper, right, we're not providing any credit to this reform in our modeling process, right? We still heavily load up, all those assumptions. After a year, I think, seeing that, reduction of litigation rates, I would say we're not still providing a full credit for this reform, but slowly we are, reducing some of the loads in our modeling process. And from my personal point of view, I'd love to see this process get like a full test after like another Irma type of major event, right? Because probably Helene or Milton is still not big enough. And also love to see sort of at the 1-year anniversary of Milton, right? Do we see any, to your point, last quarter, do we all of a sudden see some strange behaviors, right? So I want to wait, to that point, say if this, went full effect. But, to be fair, I think, we are sort of reducing some of the loads in our modeling process.
Yeah. So I think we're nearly out of time, and maybe we can have some questions in a second as well. But kind of last question, maybe to each of you in respect of outlook into 25 or also into 26 and maybe even beyond. Obviously, this is a cat bond focused panel, and I think the intention certainly of most participants is to really enable growth. So I think you said at the beginning, bringing new sponsors to the market is obviously a key component. I think getting the demand and supply of capacity is obviously another key component. But yeah, I mean, just taking into account all the investor discussions you're having, your own perspectives, I think just, would be great to hear your outlook.
Yeah, we're very enthusiastic about bonds. And, you know, I think by all accounts, it's probably going to be another record year of issuance. How much bigger than last year we can get, we'll see. We need the sponsors to come back, and it sounds like they've had a good experience. So, yeah, we're very bullish, but with the warning lights flashing that, you know, we need to keep the discipline up, try and make it a smoother cycle.
Yeah. Jennifer?
We're looking forward to coming back. We'd like to see the investor base grow and have more investors for the capacity. It looks like, you know, the capital seems to be growing in this market, so it'd be good if, in addition to the sponsors, more investors. But no, we're all, like I said, we participate in this market. It's been good, and I think we're going to continue to do that for 2025. We'll be back out.
Yeah, same for us. You know, whether we issue a bond this year is not a function of whether we've had a good experience. You know, there are particularities of the portfolio. But I think this is something we want to explore thematically in 25, 26, and going forward. I'd also love to explore thematically more on the private side, because I think there's a lot of similar risks that are being taken, where some yield is likely being left on the table relative on a risk-adjusted basis that could be good for everybody in the room. And so hopefully that's a theme that's also further explored with financial sponsors in the coming years.
Yeah, I guess, you know, in general, many of our investors had gone through a small cycle, right, from 2017 to 2024, where they saw the bad, they saw the good, they saw the self-healing nature of the asset class. You know, I think we feel very constructive given the valuation, the opportunity. You know, hopefully, right, we, you know, from the investor side, we grow together with the sponsors to really expand the universe, have more sponsors, more deals in the market. And also, I think very important, right, to have a mutually benefit relationship, right, with the sponsors where, you know, our capital gains some, you know, reasonable long-term profit, and it will provide that risk hedge, you know, to our sponsors, right? So really, both sides, you know, benefit from this relationship, and that's how it would work, you know, going forward.
All right, thank you. Steve, I think we got 2 minutes left. Any questions from the audience? Otherwise, I think we can. Yep.
You said that there isn't much appetite. I think I heard there wasn't much appetite for wildfire risk. What do you think about potential appetite for flood risk, if that has to go to the private markets?
In general, right, first, you know, NFIP, they have a fairly large issuance in the market. So I guess for flood risk, 2 things, right? Number one, probably there's more confidence around the severity than frequency, right? It's unlikely to see a significant appetite sort of on the frequency side of the flood. But on the severity side of the flood, I think, you know, as long as you can demonstrate, right, you are able to, you know, do your underwriting, you know, manage the claim. Again, the market already provide that acceptance for NFIP on the severity side.
Yeah, I mean, I would echo that there's flood risk in the market right now. I think different investors see it differently. Whether it's a diversifying peril or not, I guess is up for some kind of debate. I mean, personally, I think there's a lot of correlation between wind and flood, especially in the tail. So that tells you probably my own personal view. But
any other questions?
Just wanted to reference Chin's comment about no bad risk, just bad price, and Jennifer's comment of being unable to fill the last 900 million. Is it unable to fill or unable to fill at a price you wanted to pay? And at what point do you just walk versus meeting a clearing price?
It was unable to fill at the price we wanted to pay. And because we did go out and try to place it privately and got some quotes, and they were just much higher. So I'm a little different than other companies because we actually, in our statute there, it says that our board is supposed to do its best effort to procure catastrophe reinsurance for a 1 in 100 year event at reasonable costs. So, we work with internally with our team. We've got financial advisors, we have brokers, and we come up with where our range is of what's reasonable before we ever go out to the market. Now, granted, market changes happen. We have to regroup and decide the market's changed. But if the market price is right, but I'm being gouged because it's the last billion I need, or it's a large amount like that, we walk away. And I'm actually, that's the direction I've always had. I've been told we want to protect everybody that we can with our program, but to walk away if we're being gouged for not to pay outrageous pricing. So, and the market knows we will, and we've done it. So if it's just if you're trying to just negotiate like that, we'll leave and say we'll see you next year and try again. But that's pretty much how it works. So there was some capital out there, but it was still very hard. We tried to do another deal and had the team, the brokers, go out, and there was nobody interested in financing it. That was near the end of the season, close to June 1, at the end of our program. So, we were still covered all the way up to like the 1 in 73 year event. It wasn't way down low, but still we were trying to get all the way up.
Have you recalibrated what you think is reasonable?
We do every year. Every year we look at the market and we reevaluate that because it's not reasonable. It's not just a number on the board. It's reasonable in the market that we're in. That's how we look at it.
If there are no other questions, well, thanks for spending the last hour with us. Thank you.